Why Carmakers Will End Up Printing Tesla's Brain by Jim Osman, senior contributor. Legacy automakers will not admit it yet, but they are all heading toward the same destination. They will license Tesla's full self-driving system. When the gap widens significantly, they need to find a way to bridge it. The boardrooms know this, even if the public narrative still pretends. The race is close. The real story is revealed by the numbers. FSD version 14 is logging thousands of miles between critical disengagements. It's a jump that looks like a different era rather than a new update. A system that once struggled with the unpredictable is now feeding on it. Tesla's safety data points the same way. In the second quarter, there was one crash every 6.7 million miles on autopilot, compared with less than 1 million for non-autopilot driving and about 700,000 for the national average. The picture is not subtle. Markets rarely catch the moment when competition turns into structure. It looks like hype or noise until the compounding becomes obvious. Then the cost of catching up becomes too high for any balance sheet. The conversation shifts from rivalry to survival. Investors should stop asking whether traditional automakers will license Tesla's autonomy, and start asking when and on what terms. The structural problem legacy autos cannot escape. The challenge for legacy manufacturers is structural. It looks more like a capital issue than a technology one. Tesla trains its full self-driving system on billions of real-world miles, refreshed every day by a fleet that acts like an always-on laboratory. No incumbent has that scale, nor can any turn raw miles into a self-improving model internally. They are trying to play a compounding game, with tools built for a different century. The second problem is organizational. These companies still run on processes designed for predictable product cycles. They rely on hierarchies, slow approvals and compensation plans written for factories rather than neural networks. A software system that evolves every week does not fit inside a structure built for annual model releases. The third barrier is fear. European and American regulators are still reviewing Tesla's full self-driving system, and the idea of owning that liability terrifies boards. They spent decades refining manufacturing, safety manuals and warranty risk. Full autonomy sits far outside that comfort zone. Musk has been blunt. He has offered Tesla's full self-driving system to other automakers and watched them decline or return with pilots so small they are not real. This is the same denial that once led executives to insist online retail would remain a side channel. Investors have seen the pattern before. Tesla's advantage isn't hype, it's data. The debate has moved past opinion. The data now leads. Version 14 of Tesla's full self-driving system has reached numbers that sounded unrealistic a year ago. Community logs show well over 5,000 miles per disengagement across varied conditions, and more than 2,000 miles in dense cities. Earlier versions struggled to break the high hundreds. Anyone watching the curve can see the inflection point. Tesla's own safety reporting reinforces this. There is one crash for every 6.7 million miles driven on autopilot, compared with fewer than 1 million miles off autopilot and about 700,000 miles for the national average. The gap is widening, not narrowing. The figure gives investors a concrete point of reference. There is still noise. Regulators continue to investigate specific incidents. Lawsuits question how Tesla frames its data. Critics argue the comparisons need tighter context. Healthy skepticism is sensible, but the learning curve is real. A system trained on a global fleet improves in a way competitors cannot match. The compounding sits with a company that owns the fleet, the hardware, the software and the delivery path. Legacy automakers rely on suppliers, committees and political friction. That structure never wins software races. At some stage, the rational decision is not to replicate the stack, but to rent it. History's playbook shows what happens next. Investors do not need to guess. They have watched this movie in other industries. When one company pulls too far ahead, rivals stop pretending a homegrown system is realistic and start licensing the leader's brain. The PC market proved it early. Manufacturers tried to build their own operating environments, but could not match Microsoft's speed or ecosystem. Windows became the standard. Hardware makers focused on small differences while the margin moved to the operating system. The smartphone era followed the same arc. Nokia and others held on to proprietary systems long after the economics stopped working. The cost of maintaining an app ecosystem crushed them. Android became the default for anyone who wanted to stay in the game. Silicon repeated the pattern. Most handset and IoT makers gave up on creating full instruction sets. They licensed ARM and competed where they could. The closest preview for autos came from charging. Tesla opened its North American charging standard. Most major automakers aligned themselves with the standard within 2 years. They wanted access to the network. Stellantis resisted until the very end, then joined. Even the reluctant ones fall in line once a standard is set. These shifts do not manifest as bold strategies. They show up as quiet announcements, framed as cooperation or customer convenience. The real reason is simple. The cost of catching up becomes impossible. Autonomy is software, data, and infrastructure. FSD is the closest thing to a standard the industry has seen. What Musk is signaling and why the market ignores it. Musk has been clear about where he thinks the market is going. He has said more than once that Tesla will license FSD, and that companies refusing to adapt risk fading away. His recent posts show frustration. He says he has warned other automakers, offered them access, and watched them either ignore the offer or return with proposals so small they have no practical meaning. He calls the situation crazy. He describes companies asking for pilot programs that cannot possibly lead to deployment. He also speaks with confidence about the regulatory movement. Europe and China are evaluating FSD and the Dutch RDW has begun a formal review. Whether his optimism proves accurate is secondary. The important fact is that the process is moving forward. The market still treats these comments as typical Musk noise. Legacy boards do the same, because accepting the offer means admitting they lost the autonomy race. That is the behavioral mispricing. If one large automaker signs a real deal, the narrative turns overnight. It goes from no one wants FSD to no one can afford to be without it. How the Tesla licensing endgame unfolds. The shift will happen in stages. The first will be face-saving partnerships. Automakers will announce limited tests and describe them as strategic collaborations. They will run small programs in less visible markets or on premium trims. It will look like the early Knox moves when companies claimed they were adding compatibility rather than admitting they needed the network. The second stage will be regulatory alignment. Once one region certifies FSD at scale, others will feel pressure. An automaker can then tell its board that it is using a system already proven and approved elsewhere. That reduces the perceived liability. The internal argument becomes far easier. The final stage is standardization. As more automakers license the technology, Tesla's business begins to resemble an operating system with high-margin recurring fees. Legacy players face tighter margins but gain time and survival. Investors should start thinking in terms of FSD as a service and autonomy fees appearing in other companies' financials. The real lens is simple. Investors are not just valuing a car company, they are valuing the operating system for road transport. The market still prices Tesla as if it were selling cars with a premium options package. The gap between perception and reality is the opportunity where the edge sits for investors. The market still models autonomy in a narrow way. Analysts treat FSD as a feature that adds margin to Tesla units and attach discounts for regulatory uncertainty. Very few project a world where a large share of global EVs pay Tesla a recurring software fee, either directly or through licensing. That is the mispricing. The value sits in the software layer that others may need to survive. The edge comes from understanding how technology gaps become capital structure constraints. Legacy automakers cannot spend the tens of billions required to rebuild an autonomy stack without stressing their balance sheets. Licensing is the rational answer. It is a cheaper, faster, and safer route for shareholders. The conclusion writes itself. In markets and in life, denial is expensive. When the gap becomes a canyon, you do not try to grow wings. You rent the bridge. In autos, that bridge is very likely to say powered by Tesla.